Welcome to the monthly debt outlook. I'll be speaking about events affecting the debt markets, the domestic debt markets, and in the international debt markets, which happened in the month of February. So February is a classical busy debt market month. You have the budget and the Monetary Policy Committee meeting also. So I talk a bit about the budget. Largely a great budget, a conservative revenue, fiscal prudence, and heavy on capex. What worries the markets is subsidies, which can bloat up as we go through the year, and dependency on small savings to fund the fiscal deficit. But largely, a better budget for the debt markets because it talked about a fiscal consolidation, wherein the finance minister announced a fiscal deficit to the tune of 5.9% of the GDP. The previous year was close to 6.4%. In terms of the Monetary Policy Committee meeting, the committee members increased rates by 25 basis points. It's now 6.5. The Monetary Policy Committee members also met in the first week of February, where they announced a rate hike of the repo rate hike by around 25 basis points to 6.5, which was close to the street expectation. What was interesting in that Monetary Policy Committee decision was the dissent from two external members, which wherein they thought that RBI should, where there was an argument for a pause also. In terms of the Monetary Policy Committee meeting, we saw the RBI reducing the GDP numbers to 6.4% for the next fiscal year, and inflation forecasts were largely maintained at 5% for the first quarter of the next fiscal year. For the events through the month, what worried the markets was a higher CPI number, and the retail inflation printed at 6.52%, much above the market consensus, and that core inflation continues to remain very sticky, above 6%. In terms of US, we saw a much more healthier retail sales number and other economic indicators, which prompted the narrative of higher for longer. Our view remains that we are at the cusp of the interest rate cycle in terms of RBI would probably going for one more interest rate hike, or may also choose to stop also. But we believe the fact that higher for longer may not be there as people are discussing. What we have been observing is falling commodity prices from across wheat, or specifically food prices, to commodities, to the crude prices also. So there's a falling goods inflation, which can reflect also on the service inflation. So we have the camp which believes the fact that inflation actually come up from these levels and not remain as stubborn as some people would suggest. In terms of portfolio positioning, we believe that investors should continue to move up the duration bucket and take advantage of the higher rates which are prevalent, and that will help them in getting much better returns than in the past. What should an investor do now? We believe with healthy carries across portfolio, fixed income represents a very good opportunity for some time in the future. So every investor has to move up the risk continuum. So if you are on the lower end of the risk bucket, or an investment horizon which is less than 1 year, the ultra short term and the low duration categories look good enough. For slightly longer horizon, it's a choice between short-term and a dynamic duration fund. So essentially, what we believe is the high carry helps to create a large margin of safety for the investor, and potentially also insulates them from a challenging rate environment which may emanate. So a high carry and a possible, we believe the fact that a high carry and a potential falling rates will help the investors through this time. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.